Hello, good afternoon. Hope you're all doing well. I hope you're all preparing towards that IA. Yeah, I just heard that the IA will cover all what we've learned so far. And currently in class, we are on chapter 6. All right, we just completed chapter 6 this week. And for me, I'm now on chapter 3. Like, I'm now teaching chapter 3. Yes, because of I have to do other stuff. And like, all right, so in this session, we are going to talk about allowable and disallowable expenses. So if you have any question or any contribution, you can do that in the comment section. Right. All right. So in the just ended session, we spoke about allowable deductions, right? We spoke about year of accessible income, then the deductions to now get what are chargeable income. So here in this session, we are going to talk about some deductions or some expenses that are allowable, right? So, all right. So what are allowable deductions? So another section 9 of the Act 896, it states that um, it is only expenses that are wholly, exclusively, and necessarily incurred in the production of an income that is allowable as deductible. So what this basically means is that um, in producing a particular income, in getting a particular sales, right, was the expenses that was attributed to it actually contributed to the generation of that income. So let's say you pay you pay salaries, right? And the salaries paid was to workers that were involved in bringing this income. Yes, then it makes it what allowable. Was it exclusively for that particular, was it is it exclusively for this particular income generation? And does it necessarily form part or include in this particular income generation? Then that will make it what? Deductible. So when we talk about wholly, the wholly relates to the quantum of the amount being charged, right? So the amount of expenses that you've charged for this particular income, is it wholly attributed to it? So this is the entirely of the amount for business purposes and should wholly relate to the income. So the amount that you've paid to the income, is it wholly attributed to it? So when we talk about exclusively, it means the purpose for which the expense was made, right? So if the expense was made purposely for the business or for the generation of this income, then it is allowable, right? But if it is not, then it is not allowable, right? So necessarily basically means that the expense must be such that without it, the business cannot go on or income cannot be produced, right? So if let's say if you don't get workers to work on a particular project, and then like if you don't get them to work, then it means that it will be, you won't be able to generate this income. So it is what necessarily part. So in addition, the expense should not be of a capital nature, right? So expenses that are incurred should not be of a capital nature. So when we talk about capital nature, it can be on fixed assets or an expense that will last longer than 1 year. For example, signing up for advertisement on a billboard that will last for more than 1 year, right? It's more or less like an expense of a capital nature. So if it will last between 1 year, then within 1 year, then it is allowable. But if it will last more than 1 year, then it is not allowable. And also expenditure incurred in anticipation of commencement in trading. So any pre-expenses that you make before you start any business, it's not really attributable to that particular income, so it is not what's allowable, right? Um so this means amounts actually paid out by the business or persons or incurred and yet to be paid. This is in line with accounting base or principles of accrual. So basically, if in case you have okay, so if in case you have workers that you are supposed to pay, let's say 30,000, and you pay them 20,000 instead of 30,000, right? Since for the workers have worked on a particular business that is necessarily in the generation of the income, right? So the 30,000 will be allowable for deduction, even though you've paid only 20,000, because a year then you will pay the 30,000. That's what it means here. So while some expenses may have been paid, others do not involve cash payment, but are acknowledgement of liability payable in the future or without the need for any payment or cash equivalent. So that's what I just said. Right. Okay. So now let's look at some allowable deductions. Right. So first here is repairs and improvement. So remember that under IAS 16, a repair is to be capitalized when the cost of repair can be reliably measured, and it is probable that future economic benefits is associated with that particular item or will flow into the entity, right? But under the tax act, it is different here. So you see in the IAS, it is only when these provisions are met, right? But on the tax act, it is different. On the tax act, all repairs and improvements are deductible, whether they are of capital nature or not. However, the following rules must be applied. So what it means, what they are saying here, the first rule is that it should not exceed 5% of the written down value of the pool at the end of the year, right? So if the written down value of that particular asset is, let's say, 50,000, right? Your repairs and improvements should not exceed 5% of that written down value. So say 5% of 50,000 is 2,500, right? Your repairs and improvements should not exceed that amount. So it is also allowed in the order of expense, which is the expense that was incurred first is the one that will be allowed first. So that's it here. And then the excess expense disallowed by the limiting rule in A above must be added to the depreciation pool it relates. So we add it back to the particular pool that it relates. So in determining or computing repairs and improvement, the following procedure must be adhered or observed, right? So the written down value of the applicable pool shall be the written down value before considering the addition of the excess computed repairs and improvements disallowed. Since the deduction or capitalization will be made at the end of the year, the taxpayer should identify the pool in which the assets in which each asset which is the subject of repairs or improvement belongs to. Then now we determine the 5% of the written down value of that pool, right? So the amount of the expenditure for repairs and improvements of each asset should be matched against the 5% of the written down value. The excess amount should be capitalized, right? So if let's say the repairs and this thing is, let's say, 3,000, right? Remember, we are using the 50,000 example here. So 5% of 50,000 gave us 25,000, right? And now the repairs and improvement is rather what, 30,000, 3,000, sorry. Then the essence, which is the essence, which is the 500, is capitalized, right? To the particular asset. That's what it means here. So deduct the expense or capitalize the excess amount in which the expenses is incurred, right? So if there are more than one, we do it in the order in which they were incurred. So this is an example here. So Food Limited incurred expenses of 2,500 on repairs and improvements of plant and machinery and declared a profit of 100,000 for the year of assessment. The written down value of the applicable pool before capitalizing any excess is 60,000, right? So now what we are going to do, they say we should, we are required to find the deductible amount for repairs and improvements, and the excess amount of repairs and improvement to be added to the depreciable base. Let's look at it here. Now, what are we to use as the benchmark? 5% of this 60,000, right? So 5% of this 60,000 is what? 3,000. But the expense is what? 2,500. 5% of this is 3,000, and the allowable and the expense here is 2,500. So basically, this means that this expense is allowable, right? It's fully. So let's look at what it says. So now, profit as received new is 100,000, right? So repairs and improvement is being added back, because before we came to this repairs and improvement in our normal trading profit and loss account or statement of income, right, we already deducted repairs and improvement. So we need to add it back and then get our accessible income, because repairs and improvement with this figure is not allowed, right? It's not really allowed. So we add it back. Then now we now less our allowable repairs and improvement, which is 5% of the 3,000, right? And then our adjusted profit is now what? 99,500. So note that even though our allowable repairs is 3,000, but our repairs and improvement was also 2,500, we will not be allowed to uh, have the 3,000 as a repairs and improvement. The one that was actually incurred will be what we are going to use, right? We are not going to benefit for more than what we have really incurred. But in the otherwise, we will see an example where we will see what you are going to do when the expense is rather higher than this. So now the allowable deduction will be limited to, it is 2,500, not 25,000, right? 2,500. So this is another example. So Food Limited incurred expenses of 6,000 on plants and machinery and declared a profit of 100,000 for the year 2016 year of assessment. The written down value of the applicable pool is what? 60,000. And before capitalizing any excess is 60,000. So what are we going to do here? So what it means here is that we find 5% of this amount, which is giving us 3,000. Then now this 3,000 as compared to this one is what? It's lesser. So we are going to take that 3,000 out of this 6,000. And then the excess will be added to this profit for the year. And then the excess, that same thing will also be capitalized. So let's look at it here. So the profit received this year, now repairs and improvement, as we know already, was deducted before arriving at this profit. So we add it back to it. And our accessible income will now become what? 100,000, 106,000, sorry. Right. So now we find our allowable repairs and improvements, which is going to give us 3,000. That's what we are seeing here. Now our adjusted profit now is going to be 103,000. So basically, this is what our adjusted profit is going to be, and this is what we are going to be taxed on. So now we move on to the second allowable deduction. So the second one here is research and development. So we know businesses most often do research in order to improve their production process, to improve their goods and the likes. So those expenses are allowable for deduction, except of the petroleum and mining industries, right? So businesses all over the world spend a lot of money on an annual basis on research and development of products and or services. The research and development is considered as assets if economic benefits are expected to flow to the entity as a result of incurring the research and development. What is the provision in the Act, right? So this is what our IAS standards are saying. And this is what the Tax Act is saying. So the Section 13 of the Income Tax Act 2015, among other things, provide that a research and development expense that is wholly, exclusively, and necessarily incurred in generating income for a business or investment for a year of assessment, irrespective of whether the expense is of a capital nature is deductible in determining the chargeable income for the year. So meaning that any research and development that you make for the particular business, right? Whether it's of a capital, whether it's a long-term research or a short-term research and development, right? It's allowable for deduction. That's what it means here. So the Act further defines research and development to include an expense incurred by a person in the process of developing the business of that person, improving business products or processes, and it excludes an expense incurred that is otherwise included in the cost of an asset used in the process. So an expense that was not really involved in that particular business process is not included or is not an allowable deduction, right? Then we move on to the finance cost. And here, pay very, very keen attention. So the amount of finance cost other than the interest deducted in calculating a person's income from conducting a business or investment for a year of assessment shall not exceed the sum of financial gains derived by the person that are to be included in calculating the person's income from the business or investment for the year of assessment. So meaning that the financial cost that will be charged, right, will be allowable, shouldn't be more than 50% of the adjustable chargeable income plus the financial gain, right? So we are going to compute something down there and then you understand it better. So financial cost other than interest in deductible in calculating the income from an investment or a business, but shall not exceed the sum of financial gains derived and included in the assessable income for the business, then 50% or okay, this is what I just read. So the remaining financial cost as a result of the above limits on deduction can be carried over for 5 years, and that cost will be used in order in which it was incurred. So it is more or less like the FIFO method. So the ones that was made first are to be carried over for the ones that are made first will be deducted first before the next one comes in, right? So after calculating the finance cost based on these rules, right? If it is not up to the original finance cost, right? You can make 50 million of whatever finance cost, but if it is greater than the calculated or allowable finance cost, right? You need to take that particular part in the first year, and then the rest or the balance will be allowable to be carried over for the next 5 years. So let's look at something. So basically, let's look at this. So this is more or less like a format. So here, your net profit that you arrived at will be brought in here, right? And then you add back disallowable deduction. Remember depreciation, um, uh, depreciation, finance, cost, and those particular stuffs are not allowable in the raw form, right? So depreciation, for example, will be added back. Any other losses like any other thing like repairs and improvements will be added back just for you to come in and get your chargeable income like after everything. So now after doing this, you come and then less your allowable deductions, which can be capital allowances, research and development, again, the one that was really allowed, and then you get adjusted profit. Then you less capital allowance here. All right. So after that, you come in and get your chargeable income. Then you add your finance cost, right? Because finance cost in your profit and loss account was deducted, right? So now you come in and add it. Then finance gain was what? Added. So now you come in and less it to get your adjustable chargeable income. An example here will give us this thing. So Maniba Limited had the following transactions in 2016 year of assessment. So this is the profit before tax. And these were the following expenses. So we can see depreciation here is not allowable. So what are we going to do? It was deducted before arriving at this income or this profit. So we are going to add them back, right? Anything that was deducted before this will be added back, and anything that was added before this will be deducted. So, um, sorry, I had a glitch. So, let's look at the solutions here right now. So first, you compute the allowable finance costs and then compute the taxable. Just that after I'm done with the seat lecture, we'll start solving tutorial sets, and I'm sure that you'll get upper hand on it. So we bring our net profit before tax, which was 22,000. Then we add back general bad debts written off and depreciation. These general bad debts are not allowable, right? We'll talk about it very soon. So we add it back, and then our depreciation is also not allowable. We add it back. So we come in and arrive at this amount, then we subtract it from, sorry, we add it to this net profit before tax. We get our 30,000. So we less on relief loss 2,000, then we get this. Then now we come in and less our capital allowance, right? It is allowable. So we come in, and because capital allowance, sometimes we don't know the amount. So it is the tax man that is going to bring it, and then you now realize your capital allowance. So 28,000, then we less our capital allowance and come in and get our chargeable income, which is this one. Then now, because finance cost and financial gain was adjusted before coming to this total, right? We now add our finance cost. So in arriving at this 22,000, finance cost was what? Subtracted. But because we are reversing everything, we add it back and then get this. Then financial gain was added before coming to get this total. So now we do what? We less it to reverse the transaction, right? So this is what we end up getting, 59,500, right? So now our allowable finance cost, right, is basically the charge adjusted income plus our finance cost minus our finance gain. That's basically it here. Right. So if we really want to get our finance cost that is allowable, not our finance cost and kasankato, but the one that is allowable, it is what? The finance gain, the financial gain here, which is 7,000. 7,000, which is here, right? The finance gain, which is the 7,000, that same amount, right? Plus 50% of the adjustable or adjusted chargeable income. That's it. So plus 50% of this amount, right? So that's what we did. And then we came to arrive at this 36,750, right? So the amount of 36,760 represent the allowable finance cost for the year. The excess finance cost of 13,250, that is not allowed as deduction may be carried forward for the next 5 years. You see, our main finance cost was 50,000, but the one that is allowable is this 36,000, right? So in our income statement or in the amount that is allowable is this 36,000, right? So the difference that is left will be carried out, carried for the next 5 years. So next year we calculate the allowable chargeable income, then we find our finance cost that is allowable again. Then we see if it is if we find the finance gain or financial gain plus 50% of the adjustable chargeable income, and it is still greater, it is still lesser than this, we still take part, and then we still carry the next one to the next year, right? So this will now be our adjusted profit. So net profit will come in. Our depreciation and general bad debts will be what? Re-added back because they were taken out before arriving here. Finance cost was also taken out. So we add it back. And then now we get this. Then now unrelieved losses was subtracted and was added. And then finance cost was what also added. So with that one, we less it now to reverse that thing. So sorry. So unrelieved loss, for example, 2000 was added, right? In our previous, so reverse it, and then now we now charge our finance cost. That was really, that will be allowable. So that's what we solved here. And then we had this amount, 41,750. So this will be our adjusted profit, right? So now we now what less our capital allowance, and then now we get our chargeable income, then we apply our tax rates or tax percentage on it, and then we get our what tax. So now let's talk about bad debt. So in a normal course of business, we normally, not every business, but businesses that normally sell on credit will incur, will like have a high probability of incurring what a bad debt. So bad debts, for example, will be unreasonable if you are supposed to pay, if like you are not allowed to deduct that in your expenses. So if you make a profit and then you've not been able to receive some parts, if you make sales and you've not been able to receive some parts of the sales, then it should be allowable for deducting, right? So um, bad debt refers to claim of a person in respect of which that person has taken all reasonable steps to pursue payment, and which the person reasonably will not be satisfied. So basically, if let's say you sold goods to someone and the person has run mad, it will be very difficult for you to get your money back. And also maybe if you sold goods to someone and the person is dead, it will be very difficult for you to claim that money back. So that's why we need to allow this debt as deductible. So just that basically under the Act, there are some conditions that you need to follow and then make those, like make the bad debt expense deductible. So one of the conditions is that the amount ought to be included in the receipt and accrued, right? So the amount that will be allowable for bad debt should be included in the receipt. So in your sales amount, if that particular amount is not among your sales amount, then it is not allowable and it should be owing, right? Yes. So the debt claim is in respect of advances made by the person in the normal course of business other than advances made on the capital account. So basically, your whatever the debt should be in connection with that particular revenue. So if let's say you are selling phones, right, and then uh, the debt is rather associated with, let's say, a personal car you sold to someone, it will not be allowable for deduction under this, right? So it should be solely for, let's say, the selling of the phones that someone came to buy and is not able to pay, right? So the sorry, I had a glitch. Okay. So the debt should be in connection with a particular normal course of business that you are doing, and it shouldn't be in connection with a different business, right? The taxpayer must prove the steps to show necessary conditions that he has reached that the debt is bad and irrecoverable. So you've tried your possible best in getting the money back, right? But you are not able to get. And then there should be a specific provision, sorry, for that particular bad debt, right? So we also have rent. So rent is an amount paid in respect of land or a premise acquired for the purpose of producing income, and it is allowable. However, if the land or premise is also used for private purposes, the Commissioner General has to reject the part of the. So basically, if you rent a particular building for your business and you are not using the full building for the business, but you're using part of the building to do um, some normal business other than this part, other than your normal business, then that part that is being used for your normal business will be tax allowable, right? It will be deductible, but that part that is being used for private, this thing will not be deductible. That's basically what it means here. So in summary, this is what we've done. So we've been able to describe the general principles of deductible expenses in taxation. We've also explained the categories of expenses in taxations, that is the allowable and disallowable, right? And then we've also identified expenses that are deductible for accessible income and those from chargeable income. And we've also identified disallowable expenses. So we can try out this quiz when we are free or when we get a time. So for example, the provisions or the conditions is that the expenses or the expenditure must be wholly or exclusively or necessarily be incurred, or yeah. Then we here 5, we can repairs and improvements, bad debts, rent, the likes. Then here, assume that the written down value of an asset in pool 2 is 100,000 and repairs and improvements 20,000. What will be, so we just find 5% of this written down and then we get allowable tax expense. Then given that the accessible income for a company is 140,000, the finance cost, so just find 50% of the net income, then we are gone. 50 plus the financial gain, since there is no financial gain here. Right. So these are some things we can try out when we are less busy. Right. Okay, so I wish you all the best and see you in the next session. If you have any comment, you can leave it. If you want any further explanation, you can leave it in the comment section. Then I explain further. Thank you very much. Bye.